In the United States, the IRS classifies cryptocurrency as property, not currency. That means every time you sell, trade, or spend crypto, it's a taxable event. Selling cryptocurrency for more than you paid creates a capital gain. Selling it for less creates a loss. If you held the crypto for 1 year or less, any gain is short-term, taxed at your regular income rate, and held longer, it's long-term capital gains, usually lower rates. Conversely, if you earn crypto, whether as salary, mining rewards, staking, or an airdrop, that income is taxed like ordinary income based on the fair market value when received. To be specific, the IRS FAQ says, if you own and use a digital asset for personal or investment purposes, any gain on sale is a capital gain. But if you receive a digital asset in exchange for goods or services, it's ordinary income. In practice, common taxable events include selling or exchanging crypto, e.g. trading Bitcoin for cash or for another coin. The difference in value is a capital gain or loss. Spending crypto on goods or services, e.g. buying a car with Bitcoin. This is treated as if you sold the Bitcoin for its fair market value, receiving crypto as payment. Wages paid in crypto, mining or staking rewards, or an airdrop, POCH, hard fork distribution. All are ordinary income equal to the coin's USD value at receipt. The IRS has already taken enforcement actions in the crypto space. For example, in late 2024, Frank Algren, an early Bitcoin investor in Texas, pleaded guilty to crypto tax fraud. He underreported about $4 million in Bitcoin sales. In 2024, a judge gave him 2 years in prison plus about $1,095,000 in restitution. In another case, crypto advocate Roger Ver, aka Bitcoin Jesus, resolved federal tax charges by paying nearly $50 million in back taxes, penalties, and interest after not reporting his Bitcoin gains. These examples show that crypto income must be reported. The penalties for non-compliance can be severe. Even innocent mistakes carry fines. For example, a 20% accuracy-related penalty applies to any tax underpayment due to negligence or substantial underreporting. If the IRS finds willful fraud in hiding crypto transactions, the civil fraud penalty jumps to 75% of the underpaid tax. In the Roger Ver case, he owed the maximum fraud penalty under Section 6663, over $12 million. Criminally, deliberate tax evasion is a felony. Convicted taxpayers face up to 5 years in prison and $100,000 fine. To stay compliant, use proper tools. There are specialized crypto tax software and apps that import your wallets and exchange data to calculate gains/losses. For example, platforms like CoinLedger, formerly CryptoTrader.tax, and CoinTracker connect via API or CSV to dozens of exchanges and wallets, automatically classify transactions, and generate IRS tax forms. These tools even integrate with popular tax software, TurboTax, H&R Block, TaxAct, to make reporting easier. Other services such as TokenTax, ZenLedger, or Coinly offer similar features, often with audit support. Even mainstream tax programs now support crypto. As mentioned, TurboTax lets you import thousands of crypto trades. Using these tools or consulting a crypto-savvy CPA can help ensure you report everything correctly. In summary, treat your crypto like property. Report all sales, trades, conversions, and any crypto income. Keep detailed records of dates, amounts, cost basis, and proceeds for each transaction. The IRS is increasingly monitoring digital assets, even requiring crypto brokers to file 1099-DA forms. So it's best to calculate and pay any crypto taxes owed each year. Filing an accurate return or an amended return if needed is far safer than risking penalties or enforcement actions. By using the right software or professional advice, most crypto investors can handle their tax obligations properly.